Now, as you have probably already guessed from the title, today we will be ranking AI stocks and figuring out which one might be the best buy at its current trading price. Also take in account that it is very likely that we are currently in a big AI bubble, and that in the next few years, many AI companies might dramatically fall in price or even cease to exist. And therefore, for our list, I picked companies which are the most likely to survive this time and are the current leaders in their industry. So let's jump to the first stock, which is NVIDIA. We will plug in the ticker NVDA and all the metrics will show up automatically. Now right away we can see that since 2022 the income of NVIDIA has decreased, as well as their free cash flow and their total equity. Their dividend yield is currently sitting very low at only 0.04%, but they have a very decent trading payout ratio of only 7.7%. Now we can move to the 9-pillar analysis, where we value the long-term metrics of a company. Right away we can see that the 5-year PE ratio and the price to free cash flow over the past 5 years are both sitting above the values we like to see. The PE ratio is sitting at 105, which means that NVIDIA is currently trading at 4.5 times its earnings, which is not a good sign. We can also see that their net income, their revenue, and their free cash flow have all been increasing over the past 5 years, and not by a small amount, which is great. Also, NVIDIA's long-term liabilities of the 5-year free cash flow and negative dividends is sitting at only 0.57, which means that NVIDIA really doesn't have much debt, which of course is a good sign. Now we can move to our first valuation model, which is the Grimes formula revised. Here we take the very low earnings per share of NVIDIA and get an intrinsic value of $169.49, which is 154% lower than the current trading price of the stock, pointing out NVIDIA's very low earnings per share compared to their current trading price. Now before we move to our second valuation model, if you like these spreadsheets and you would like to download them, you can do so at my Patreon at the link in the description. Now our second model focuses on the free cash flow of NVIDIA. We take the free cash flow of the past 10 years and calculate the average growth rate to be sitting at 30%. We then use that growth rate to calculate the future free cash flow of NVIDIA, and then using the discount rate, we calculate the present value of that future free cash flow. We then sum up all the future free cash flow, add any cash and cash equivalents, subtract total debt, and get an equity value, which we divide by the shares outstanding and get an intrinsic value of $37.62, much lower than the current trading price of NVIDIA. Now this points out NVIDIA's very low free cash flow compared to their shares outstanding and compared to their trading value. Now our third valuation model is the multiples valuation model, where we compare NVIDIA's PE ratio to the PE ratios of other companies which operate in the same sector. And as we can see, NVIDIA's PE ratio is much higher than the average PE of these 4 companies, which gives us an intrinsic value of only $52.10, again much lower than the current trading price of the stock. Now our final valuation model is the dividend discount model, and here we take the dividend payout over the past 5 years and calculate the projected growth rate to be sitting at 0.4%. Now as the projected growth rate is much lower than the WACC of the company, the intrinsic value comes out to be only 1.11%. Now for these situations, I have my alternative dividend discount model, which is based on the stock price next year, the next year's dividend, and the WACC of the company, and this alternative model gives us an intrinsic value of $360.60. Now when we jump to our ultimate valuation, we average out the Grimes formula, multiples valuation, discounted cash flow valuation, and the alternative dividend discount model to get an intrinsic value of $154.95, 63.96% lower than the current trading price of the company. Now the next company we'll have a look at is Analog Devices, ticker ADI. So I will plug the ticker in and the metrics will show up automatically. And right away we can see that their total equity decreased from 2022, but their income increased as well as their free cash flow. They currently have a trailing payout ratio of 61% and a dividend yield of 1.79%, a very decent dividend yield for a company operating in ADI's sector. Now when we jump to the 9-pillar analysis, we can see that the 5-year PE ratio of ADI is indeed much better than the P ratio of NVIDIA, sitting at 33.16, which means that ADI is overvalued by only about 50% compared to its earnings. Again, much better than NVIDIA. Now we can also see that their 5-year profit margin is sitting at 65% and that they have been increasing their net income, revenue, and free cash flow over the past 5 years and by not a small amount. Finally, they also have a very decent consecutive dividend growth of 10.25%, and their long-term liabilities of their 5-year free cash flow negative dividends is sitting at 1.59, meaning that they can pay off most of their long-term liabilities in about 8 to 9 years while paying out a decent dividend. Now, when we jump to our first valuation model, we can see that when we plug in the earnings per share of ADI, we get an intrinsic value of $142.81, only 34% lower than the current trading price of the stock. Now, when we jump to the discount cash flow model, we plug in the future growth rate of 25% year over year, and using that we calculate the future free cash flow over the next few years. We then plug in the discount rate, and using that we calculate the present value of that future free cash flow. We then sum that all up, add cash and cash equivalents, subtract total debt, and get an equity value of $128 billion, which we divide by the shares outstanding and get an intrinsic value of $256.08, by about $60 higher than the current trading price of ADI, which is much better than NVIDIA. Now, when we jump to our multiples valuation model, we compare ADI to these 4 companies. We took these companies' average PE ratio and multiplied by the earnings per share of ADI to get an intrinsic value of $273.09, again much higher than the current trading price of the company, meaning that ADI might be undervalued compared to the companies located in the same sector. Now, when we move to our final valuation model, we take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 12.27%. We then project a growth rate of 10%, but as the projected growth rate is higher than the WACC of the company, the dividend discount model gives us an intrinsic value of negative $429, and therefore again we will use the alternative model, which gives us an intrinsic value of $186.36, slightly lower than the current trading price of the stock. Now, jumping to our ultimate valuation model, we take the Graham's formula, multiples valuation, discounted cash flow valuation, and the alternative dividend discount model, average them out, and get an ultimate intrinsic value of $214.59, 11.83% higher than the current trading price of ADI. Now, if we plug in a margin of safety of 15%, we get an acceptable buy price at $182.40. Now, based on our so far valuations, I would say that ADI is a better investment than NVIDIA. But let's jump to evaluating our third company, which is Microsoft. So we'll plug in the ticker MSFT, and all the metrics will show up automatically. And right away we can see that their total equity increased by 17.29%, and their income has been increasing since 2021 very steadily as well as their free cash flow. Microsoft currently has a dividend yield of only 0.81%, slightly lower than the one of ADI, and a trailing payout ratio of only 32.59%, slightly better than the one of ADI. Now, jumping to the 9-pillar analysis, we can see that Microsoft's PE ratio and their price to free cash flow over the past 5 years are both sitting above the values we like to see. Now again, this means that Microsoft is slightly overvalued compared to their earnings. On the other hand, they also have a very high 5-year profit margin, and their net income, their revenue, and their free cash flow have all been increasing over the past 5 years. And looking at the dividend growth, we can see that that has been growing by about 10% year over year, and that their long-term liabilities over their 5-year free cash flow negative dividends is sitting at 0.64. Again, meaning that Microsoft would be capable of paying off their long-term liabilities with their free cash flow in about 3 to 4 years while paying out a healthy dividend. Now again, jumping to our first valuation model, we take the earnings per share of Microsoft and their 5-year growth estimate and get an intrinsic value of $160.99, 110% lower than the current trading price of the stock. Now, you have probably already registered that in this video, when we do the Graham's formula revised, the intrinsic value always comes out lower than the current trading price of the company. And this is because we are evaluating companies which operate in the tech sector. Now moving to our discounted cash flow model, we take the free cash flow of the past 10 years and calculate the average growth rate to be sitting at 12%. Now I project the future growth rate to be sitting at 13%, and using that I predict the future free cash flow, and using the discount rate I predict the present value of that future free cash flow. Now using this valuation, we get an intrinsic value of $280.76, slightly lower than the current trading price of the company. Now when we move to our multiples valuation model, we compare Microsoft to Taiwanese Semiconductors, Analog Devices, Google and Apple. We take these companies' average PE ratio and multiply by the earnings per share of Microsoft to get an intrinsic value of $238.18, again lower than the current trading price of Microsoft. Now when we move to our final valuation model, we take the average dividend growth rate, which is sitting at 10.26%, and project a growth rate into the future. Now again, as the projected growth rate is higher than the WACC of the company, we get an intrinsic value which is negative, and therefore we'll use our alternative dividend discount model, through which we get an intrinsic value of $316.57, slightly lower than the current trading price of the stock. Now when we move to our ultimate valuation model, we get an ultimate intrinsic value of $249.12, 26% lower than the current trading price of Microsoft, which is slightly better than NVIDIA but slightly worse than ADI. Now when we plug in a margin of safety of 15%, we get an acceptable buy price at $211.75. Now moving to the final company of the video, Taiwanese Semiconductors. We will plug in the ticker TSM and the metrics will show up automatically. And right away we can see that TSM has been increasing their revenue, gross profit and net income, as well as their free cash flow. They currently have a dividend yield of 2.09% and a trailing payout ratio of 45.4%. Now the stock is currently sitting at a price of $107.41, and the analysts predict the price of $111 by the end of 2023. Now when we move to the 9-pillar analysis, we can see that the PE ratio of Taiwanese Semiconductors is sitting at 22.97, which is very near our wanted value of 22.5, meaning that Taiwanese Semiconductors might as well not be overvalued at all compared to their earnings. Their 5-year profit margin is slightly lower than the one of the companies we had valued before, but they also have a very good net income, revenue, and free cash flow growth over the past 5 years. Their long-term liabilities over their 5-year free cash flow negative dividends is sitting at 1.87. And finally, the consecutive dividend growth isn't showing, but if we scroll down, we can see that there is indeed a mathematical error in the sheets, and the dividend growth would be sitting at about 10% annually. Now we can move to the Grams formula, where we take the earnings per share of Taiwanese Semiconductors, their 5-year growth estimate, and get an intrinsic value of $64.32, 67% lower than the current trading price of the stock. Moving to the discounted cash flow model, we take the free cash flow over the past 8 years and calculate the average growth rate to be sitting at 36.36%. We calculate the future growth rate of 33% annually, and using that we predict the future free cash flow, and after that, using the discount rate, we project the present value of that future free cash flow. After that, we get an intrinsic value of $216, which points out Taiwanese Semiconductors' excellent free cash flow. Now moving to the third valuation model, where we compare Taiwanese Semiconductors to these 4 companies. We take their average PE ratios and multiply by the earnings per share of Taiwanese Semiconductors to get an intrinsic value of $256.57, about $150 higher than the current trading price of the company, meaning that Taiwanese Semiconductors might as well be very undervalued compared to their peers. Now moving to the final valuation model, we take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at negative 12.81. But as we can see, this negative average is mainly due to the negative growth from 2018 to 2019. If we have a look at the years 2020 to 2022, the average growth would be sitting at about 7.30%. Therefore, I project the future growth rate of 7.30%, and as this is lower than the WACC of the company, we can use the normal dividend discount model, which gives us an intrinsic value of $137.34. Now moving to the ultimate valuation model, we average out the 4 valuation models and get an ultimate intrinsic value of $160.13, about 50% higher than the current trading price of the company. Now plug in a margin of safety of 15%, we get an acceptable buy price at $136.11. Now say we want to plug in a margin of safety of 25%. If we plug in a margin of safety of 25%, we still get an acceptable buy price at $120.09. Now it is obvious that Taiwan Semiconductors is trading much lower than its intrinsic value, and this does have a very rational explanation. Many investors fear that the dispute between China and Taiwan might lead to a conflict between the two countries, which would very likely destroy TSM. Therefore, the high risk of investing into this company is keeping it from reaching its intrinsic value. Now to rank the companies from my view, ADI and TSM both share the first place, considering the high risk of investing into TSM. Second place goes to Microsoft, which is trading fairly close to its intrinsic value, and the last place goes to NVIDIA, as they are trading far above their intrinsic value, and I do believe that their current price is completely irrational and that it will fall in the next years. With that, if you enjoyed the video, make sure to leave a like, consider subscribing, and let me know down in the comments which companies you would like me to evaluate next.